Hello and welcome to episode 413 of the Money to the Masses podcast with your resident expert, as always, Damien Fay, and me, Andy Leakes. Damien, you've been moonlighting this week.
Again, I have to say again, because first of all, I mentioned last week, I think it was, that I'm appearing on another podcast. So Interactive Investor, known as II these days, asked me to go onto their podcast to talk about investing mistakes and my first investment I ever made. So that episode is out now. We'll put a link in the notes of the podcast so you can listen to my story and what I talked about. Because this week I've been on another podcast. So I mentioned in the previous show that I was appearing in a live podcast record for PensionBee. Well, I went and did that. It was in White City, which is West London. And that was last night. It was a great event. So there was a panel of guests. I was one of them when they included Claire Barrett from the FT. And we were talking about pensions versus ISA. So that show will be out, I think, at the end of May. But we will put links to it because it was an interesting podcast and there was a lot of interaction with the audience, but also questions and personal stories. And what I've learned from doing these live events is that people do like the personal stories, so talking about our own finances and experiences. And so that is actually going to feed slightly into one of the pieces I'm going to do on the show today. Before I get onto that, Andy, I did want to mention a small win that I had, because a couple of weeks ago I went down to Brighton and I went to a conference down there, and we have talked about on the podcast in the past something called delay repay. So if your train journey is delayed, you can claim a refund or a partial refund for the cost of the ticket that you purchased to travel on the train. So just to give a quick summary of my experience, I travelled down to Brighton on an open ticket. So I wasn't on a particular train. And I knew before I set out that the journey was going to be delayed because there was a closure on the line that happened throughout the day, caused massive delays. And my train ended up being delayed. I got on, so it wasn't one I was aiming for. Actually, in fact, what happened, I was going to leave to get down there in the early evening. It was chaos on the trains. I could see that when I was looking on the apps to see what was happening with the journey time. So I decided to go 2 hours later. I then travelled into London to then go back out to Brighton, and the trains were all messed up and delayed, and the train that I got actually entered Brighton, so arrived in Brighton almost half an hour late. And while I was on that train, I searched delay repay on our website. You can just search it into Google, and I started to fill out the refund form, the compensation form for that particular rail company. It took me literally minutes to do. In a moment I stepped onto the platform at Brighton and knew the exact time that the train had arrived and how late it was. I could click submit on my claim, and that was it. Fast forward to 2 weeks later, and a partial refund of my ticket hit my bank account. So it's definitely worth doing if you are delayed on a train. You can even start submitting it while you're sitting on that train, and then when you arrive at your place you can just put submit. So it's something to make sure that you do. As I said, search delay repay in Google or look at it on our website, and we have just updated our article on the website. Well, I say we, Andy has updated the article about the train strikes that have been announced and what your consumer rights are. So we will put a link in the notes of this podcast for you to go and have a read of that, and you'll get more information about what you can claim if you are impacted.
Yeah, that's a timely reminder, Damien, because I must admit, and I know this is terrible to admit this, bearing in mind we do a money podcast, I don't always do it because of the faff, but you've just given me the inspiration to make sure that I do that, because I always think it's going to take too long. And doing it on the train is a great piece of advice. How much did you get back, by the way?
I got back a third of the ticket price to go down there. So it cost me just over £20 for the ticket, and I got around about £7 back. And my train in the end was delayed by it was just under half an hour. So there's different sort of tierings that go on, but it's worth doing. And like I said, like you, Andy, I'm not somebody who always remembers to do these things despite doing a money podcast, but because we'd mentioned it before, and that's the point of these podcasts, people suddenly have a light bulb moment and think, yeah, do you know what, I can do this. I searched our site for the details and then I actually put a claim in. So there you go. It's worth doing.
Okay, so let's get on with this week's podcast then. What have we got coming up in today's show?
So I'm revisiting pound cost averaging versus lump sum investing. So it's something we've touched upon in the past on the podcast. I will refer you back to the episode in the piece. But there's been a bit of new research from Vanguard, but it ruffled a few feathers because Paul Lewis of Moneybox fame started to claim that people should start challenging advisors who recommend pound cost averaging and actually stating they might have a claim. So I want to talk about that piece of research. I also want to talk about something that was inspired by my interactions with people in the live audience at the event that I've done, and also my personal experience with my finances. So I'm going to open up something about my own finances that's occurred, and it's the importance of having a plan. And the third piece on the podcast, Andy, is going to be you and Harvey.
Yeah, so we've had a lot of questions coming in recent weeks talking about negative equity, particularly first-time buyers, because obviously we've been in a period where house prices have been booming, but that's starting to change slightly and people are starting to question negative equity. Is it going to impact me? If it does, what can I do about it? So Harvey's going to go through the basics, explain what negative equity is, how you can work it out, and what you can potentially do about it. Okay, so let's start with the first piece then, pound cost averaging.
So Vanguard have produced a new piece of research that has been doing the rounds and caused a bit of a stir because, as I mentioned, Paul Lewis, who used to be the host of Moneybox, I don't think he's the host any longer. And he started writing on Twitter about how this was evidence that if your advisor has recommended that you drip money into the market, then you may have been misadvised. Now, that's obviously upset a lot of financial advisors, but I want you to quickly look at this piece of research because it's come to the fore again and give my view on it and reference some past pieces of research. So pound cost averaging, just for those people who don't know, is a method of dripping money into the investment market. So you can, if you've got a lump sum, you can decide, right, I want to start investing and I can put it all to work today. So you invest your money all at once. Now, there is an alternative method where you could decide to try and put your money in the market over a period of time. So usually that would be in equal installments over a set period of time. So that's called pound cost averaging. Now, that's opposed to trying to market time. So trying to predict when would be a good time to go into the market so you could optimize your return. So pound cost averaging, it may be, for example, you decide to drip your money in over 10 equal installments over 10 months. So over 10 months, you put a tenth of the money you have available into the market, into your chosen investment, and each month you do the same for the full 10 months until after the 10th month you have all of your money invested. Now, the idea behind why that is attractive is because if you imagine that you invest all your money up front, then if the market were to suddenly collapse, then you're immediately starting to lose money. If, on the other hand, you dripped in regular installments and the market immediately fell after the first installment went in, what actually happens then is by month 2, let's assume the market is still falling, you've bought more units or shares of the investment that you're purchasing for the money that you're putting in. So you're getting more bang for your buck. And as the market continues to fall, if it does, you're effectively buying even more of that investment. Think of it as buying it at a discount. You're getting more for your money. Then when markets hopefully rebound, then the installments that you invested when markets were low will have actually grown more in price. So if you think about it, I always like to think of things in extremes. If you imagine you put all your money to work on the 1st of January, the market fell during the year, then rebounded, and by the 1st of January next year was back where it was at the previous year. So basically the market had gone down and back up, you would be flat. So your return would be zero if you'd put your money to work on the 1st of January the previous year. Despite the downs, you would have ended up back where you started. If instead you dripped your money in using pound cost averaging over that year, then what would have happened? The first installment you made on the 1st of January, for example, that would by the end of the year be at the same value as when you initially invested it. But the second, third, fourth installments, you bought in at a lower rate. So when the market rebounded, actually those individual installments are sitting on profit. So when you add all that up, by using pound cost averaging in that example, you would be better off. So Vanguard have recently published a piece of research that looked at the performance of global stock markets and the UK stock market between 1976 and 2022 and contrasted the fortunes of lump sum investments versus pound cost averaging investment strategies over 1 year periods. And so they used the FTSE UK All Share as the representation of the UK market and the MSCI World Index to represent the global stock market. And they looked at using pound cost averaging over a 3-month period, over a 4-month period, a 5-month period, and a 6-month period. So what that would mean, the 3-month version would be they divided the lump sum into 3, and then on month 1 they invested 1 installment, then on month 2 the next installment, and then month 3 the final installment. And they looked at how those investments had performed, and then they worked out the win ratio for lump sum investing versus dripping in, so pound cost averaging. And what they found is that the lump sum investment strategy outperformed on 67.8% of occasions the 3-month pound cost averaging strategy. For the 4-month strategy, so dripping in over 4 months, then that changed to 68.9%. If you move out to 6 months, so you dripped the money in over 6 months, then the lump sum investment strategy outperformed on 70.8% of occasions. Now, I didn't go through all the different variations because basically the number is around 70%. So lump sum investing, based on their research, outperformed on around 70% of occasions versus dripping in. When you look at the UK, so those numbers I gave us for the global market, if you look at the UK, it's pretty much the same. So the research would suggest that, okay, maybe the optimum strategy, if you're looking at the statistics, is to put your money in as a lump sum rather than drip in. And of course, if you look at those numbers, the longer the drip period is, the more likely that investing a lump sum would outperform. So that is kind of intuitive, because if you take longer to put your money into the market, then more of it's out of the market, and so it won't necessarily benefit from any compounding that happens when your investments hopefully grow. So at a headline level, that obviously grabbed people's attention. But the thing is, when you look at those numbers, still on 30% of occasions, it didn't outperform. If it had been 99% of times that the lump sum strategy would outperform, then I might get really excited about it. And the idea of dismissing the drip-free strategy to me was slightly sensationalist. And now, first thing to point out is that this data only looks at 1976 to 2022. But if you go to our episode 332 of this podcast, I actually talked about pound cost averaging versus lump sum investing and looked at some of our own research. Now, in that particular podcast, I do mention that Vanguard did a previous piece of research back in 2012. So they've obviously decided to update it, where they looked at 10-year rolling periods going back as far as 1926. So a bit more conclusive, and they found that across all markets and timeframes, on average, the lump sum upfront method outperformed the drip-free strategy 67% of the time. So that is quite consistent, that number. So it's something to bear in mind. And they found the average performance boost over a 10-year period was 2.2%. But I also talked about some research that I carried out, and I was looking at timeframes of 5 years or more. And what I think the numbers that I crunched and talked about in that episode show is that really what pound cost averaging is not about the optimum performance for investing. It's about an insurance policy. So think of it like insurance, because on 30% of occasions, then you would have been worse off investing a lump sum versus a dripping in strategy. And so think of it like having home insurance. For most people, they never claim on it, and hopefully they never get burgled. But does that mean it's not a worthwhile product? Now, that's obviously going to be a personal view, but really what pound cost averaging is really a method that works a lot like an insurance policy against a severe market downturn. And if you are particularly cautious or you are concerned about the market might fall, then pound cost averaging is a strategy that I still think has merit. So in my mind, what the research also needs is some context as to what the outcomes could be, because just winning and losing is one thing, but the size of those wins and losses is actually very important, because when you're investing, if you can limit the size of drawdowns, that would have a huge impact in your eventual returns. So Vanguard do touch upon this slightly in their research that they've published, where they look at the outcomes of their research and looked at the percentile. So if you invested in 100% equities, for example, then the 95th percentile, so the quite extreme end of success, the lump sum strategy of investing £100,000 for 1 year produced £139,453. The drip feeding strategy over a 3-month period produced £131,012. So actually they use dollars, but it doesn't really matter. I'm saying pounds. But that is the ultimate win. That's the really good news. And they looked at the sort of 50th percentile, so it's kind of the average. What I'm interested in when you're looking at something that's meant to be a strategy that's really giving you some insurance, helping people sleep at night, is the other end. So the extreme other end. So the 5th percentile, the lump sum strategy produced a return. So at the end of 1 year, the £100,000 was only worth $82,947. The pound cost averaging strategy was worth $85,906. That's quite a significant difference. And if you go back to the research that I carried out for 80/20 Investor back in 2016, where I looked at some of the worst periods to invest. In fact, the worst 5-year period back then was the 5 years after the dot-com bubble burst. So back at the end of 1999 to late 2004, that 5-year period. If you compared the performance of investing your money up front at the start of that 5-year period versus dripping your money in over 12 months or over 4 quarters, so you did it in 4 equal installments, the difference in performance was really significant. So for the lump sum strategy, you'd be down 20%, but for the drip strategy, so the pound cost averaging strategy, you'd be up 7%. So again, don't dismiss the pound cost averaging strategy. I worry that people obsess about the optimum all the time. They're trying to get the perfect solution. It's what makes you comfortable, what makes you sleep at night. If you're worried about markets falling, then there is still merit. Yes, hindsight can tell you there would have been a better option, but when you're sitting there and you're making a decision, if all of the inputs that you have to that decision and you reach one that you're happy with, always remember the process you got to get to that decision, and then in the future you aren't going to beat yourself up about it. But of course, it's not just about drip in versus lump sum. There are other things that impact returns. Of course, what you invest in, not reviewing your portfolio, paying too much for your investments. All of these things have huge impacts on your investment performance. So do I think it's bad advice to drip in? No, I don't. If the person is worried about markets falling, they should be investing for at least 5 years anyway. But what is worse is if people sit on the sideline trying to market time, which inevitably they will probably get wrong because it's very hard to market time. It's essentially luck. And it's worse that they would sit in cash for years on the sidelines, not investing through fear, because then there is that lost opportunity from the returns, but also inflation would be eating away at their investments if they're sitting in cash.
Okay, so let's bring Harvey onto the show then. And Harvey, you're going to be talking about negative equity. We've had a few questions in the last few weeks, and we thought, well, hang on, let's package this all together. Let's do a piece on it because obviously it's something that people are interested in. So what are we going to cover in this piece?
Hi, Andy. Thanks for having me back. Yes, so we've had a few questions, as you said, and what we're going to talk about is the very basics of negative equity. We're just going to describe how it comes about, how you can work out whether you're in negative equity, what your options are, and essentially how you can avoid getting yourself into a situation where you fall into negative equity too, for those people that want to avoid such circumstance.
Yeah, and obviously in recent years, we've seen house prices rising and it's not really been on people's radar. But in the last couple of months, we've started to see the housing market sort of stagnate a little bit and even house prices falling, although recent news says they're back up again. Basically, we don't know where we are at the moment. And there are a lot of new buyers out there, first-time buyers, that are in the position where they're having to remortgage or thinking about remortgaging. And suddenly this is becoming something they're thinking about. So like you say, this is the very basics. Let's start with the really basic first question. What is negative equity? How do you work it out?
Okay, Andy, so negative equity is basically a way of describing a situation where the value of your home is less than what your outstanding mortgage value is. So essentially, you owe your lender more money than you can raise by selling your home. And you can also look at that figure in terms of loan to value. Loan to value is a way that mortgage people will describe the ratio of loan to the value of your home. And you can work that out by taking your outstanding mortgage balance dividing that by your property value and multiplying it by 100. That will give you a percentage. That percentage, if it's below 100%, is good. It's healthy. It means that you own some of your home. And if you had to sell your home, you would be able to repay all of your mortgage. But if that number is over 100%, it means you're in negative equity. It means that if you sold your home, you wouldn't be able to raise enough money to repay the debt that you owe on your mortgage.
Okay, so let's say we've done that calculation. I've done that calculation myself. I'm over that 100%. Let's say the figures here are showing 110, 120%. I am in negative equity. What does that mean for me? What are the problems? What are the implications to that?
The implications can be none at all, Andy. So if you are in no need to sell your home and move and buy a new home, or to remortgage the deal that you're currently on with your mortgage lender, then essentially you can sit tight and do nothing and hope that house prices increase, and also that with continuing to repay your mortgage, that your mortgage balance reduces and corrects that negative equity for you without you having to do anything at all. Now, if you find yourself in circumstances where you do have to move, so if you're looking to either sell your home and move to a new home or remortgage your deal that you're on currently, then at that point, the negative equity may affect you.
Okay, so there's two scenarios there. Can we go through both of them briefly? So let's look at this scenario which most people will be in, which is staying put but having to remortgage.
Absolutely. So remortgaging is something that a lot of people are thinking about, are worried about, perhaps slightly concerned about, just because of the shift in market rates. But also those people that are finding themselves in negative equity might have more to be concerned about, because generally lenders do not like to lend at over 100% loan to value rates. So if you're in negative equity, it does shrink the mortgage market in terms of the number of lenders and the number of deals that you may have access to. But in that circumstance, the best thing to do is open up a conversation with your current lender, speak to them about what options they can provide you with. And if you don't find help there, then speak to an independent mortgage broker who will be able to scout the entire market and come back to you with options that may be available to you.
Okay, so that's interesting. So opening up that dialogue with your existing lender is a good thing to do, I suppose, because obviously you'll probably be on a standard variable rate at that point. Maybe interest rates are affecting you. It's in their interest for you to find a solution, right? They don't want you to default on that mortgage. And so there may be something they can offer that's slightly better than the standard variable rate that you might be on.
Absolutely. So standard variable rates are relatively high at the moment. So it may push your mortgage payment beyond what you can afford. And in any circumstance, if you find yourself unable to pay your mortgage payments or afford your mortgage payments, then you should speak to your lender as soon as possible, and definitely before you start falling into arrears, so that they can positively approach the situation and offer a solution to you. If they're not able to, then you should speak to an independent broker, like I said, because even though your own lender may not come up with a solution in this scenario, there may be other lenders who are able to help you.
Great. And we'll put some details in the show notes regarding independent mortgage brokers and how you can get in contact with one if you don't know one already. Okay, so let's look at the other scenario then. For whatever reason, you do need to move property, but you're in negative equity. What are the options then?
It's not an ideal situation, Andy. So if you do need to move home, what you would have to do is ask your lender whether you can take the residual debt with you. So normally what happens when you sell and move is that you sell your home, repay the mortgage that you have, and start a new mortgage on the property that you're purchasing. But in this scenario, you would still have an outstanding amount with your current lender, because your property would not return the value that you need in order to repay your mortgage balance. And in that circumstance, some lenders will allow you to take that residual debt with you and carry it forward to the new property. Some will arrange a separate payment plan, and you may be able to incorporate it into your new mortgage if your new mortgage allows that to happen. But the best thing to do is to look at whether you can repay that residual amount. And in circumstances where there's perhaps more of a gap between the property value and the mortgage balance, you may find it easier to stay in your current property until such time as house prices improve and you're able to do something more positive with that situation.
Okay, so a lot of that focuses on moving maybe perhaps to a new mortgage because you're moving properties. What happens if you're completely out of the mortgage market? maybe you're going into renting. You can't move that debt across onto another mortgage. What is your situation there? Would it be a payment plan?
Yes, essentially, you'd have to agree a payment plan with your mortgage lender. It is something that you need to consider carefully because it may have a detrimental effect to your credit score. Arranging that kind of payment plan is not ideal if you're trying to maintain a healthy credit score. But in dire circumstances, yes, it is possible to arrange that with your lender. And this will also be on a case-by-case basis. So lenders don't all look at the scenario the same way. Different lenders will have different criteria that they have to meet in terms of lending. But it is best to have that conversation, understand your options, then go to an independent broker, understand what your wider options might be, and make a decision from there. But again, with the credit score, I think it's something that you have to consider very carefully.
Might you be able to move that mortgage over to a buy-to-let and rent the property out?
Yes, that is possible. So if you meet the buy-to-let criteria with your lender, they may offer that to you, and it may be that you're able to switch your mortgage to a buy-to-let mortgage. But the thing that you'd have to consider is whether your rent that you would pay if you moved out into a rental property yourself would be low enough to make that worthwhile financially for you.
Okay, so you've explained some of those options available to people. I've heard people talk about a negative equity mortgage. Is there such a product?
So yeah, I saw this as well, Andy. Negative equity mortgages is something that you may see mentioned across the internet and in various articles. But negative equity mortgages are just scenarios where a lender has agreed to offer you a mortgage based on the fact that you have negative equity. That isn't a specific type of product that's called a negative equity mortgage. One of the things that you do have to bear in mind, though, is that mortgages that are offered in scenarios where there is negative equity and the loan to value is higher than 100%, you are likely to pay higher interest rates. So you're probably not going to get the most attractive interest rates available in the market. You'll probably also have to be wary of early repayment charges and the extra mortgage arrangement fees that you might have to pay if you have to rearrange your mortgage to, say, another lender.
Okay, so we've talked about what negative equity is. We've talked about how to work it out and actually how it could impact you. For those people where this is starting to ring maybe some alarm bells, is there anything they can do? How can you avoid getting yourself into this situation? Can you avoid negative equity?
There are things that you can do to minimize the chances of negative equity creeping in. The best thing to do is to put down as large a deposit as you possibly can when you purchase your property. That might be hindsight for some people who have already bought their properties. But if you are looking to purchase and this is a concern of yours because the market is fluctuating and you're not really sure whether you're buying at a high price or a low price, then look at property values in your area, look at sold prices in your area. We will link out to another article that actually talks about how to negotiate the best house prices, because if you can buy your house for less and pay a larger deposit, you are reducing the loan to value ratio. The loan to value ratio determines how much of the house is yours. The more you own of your house, the less likely it is that you'll fall into negative equity. And that's one of the best things that you can do. The other thing that is worth mentioning is that you choose a repayment type of mortgage. Now, most people sort of take that as a given. Most people do arrange their mortgages on a repayment basis. But if for any reason you're considering an interest-only type of mortgage where you're only paying the interest and the mortgage balance thus remains the same throughout the term, that is a scenario where you may be more likely to fall into negative equity because the mortgage balance is not reducing.
And you're more at risk from those house price moves. And obviously that leaves you in a bit of a precarious position. I found myself in that position just after 2008. The world went a bit crazy and I had an interest-only mortgage. And of course, you touched on it there about paying a higher deposit and maybe hindsight for some. But if you are able to, then obviously that will help to ensure that you have a lower loan. If you have a lower loan, then of course you'll be paying less interest. And if you do that sort of calculation, how much are your savings actually earning you in terms of interest? And can you balance that off with how much you'll save in terms of the extra interest you'll pay? So it makes perfect sense to take all of these things into consideration, especially when negative equity is now being talked about. Okay, thanks ever so much for coming on and explaining that, Harvey. What we will do, as always, is we'll put a link in the show notes to a couple of articles that explain negative equity and your options in a little more detail. Okay, so let's move on to the final piece of the podcast then, having a plan. Damien, what have we got here?
So in recent weeks, I've been doing podcast moonlighting. I know, Andy, it probably upsets you slightly, but each of those times I've been on a podcast, I've been asked questions that relate to my own finances, and I've told stories, anecdotes about what's happened to me in the past, or about how I have coped with certain situations, about when I've had a pension or when I've not contributed to pension. And it is evident that people value that because I am a real person. Like I do worry there are many people who are experts in various fields, including money, who go around and dictate to people and make people feel inferior and failures with money. The reality is there is no perfect solution to money. There is no optimum way to do anything. We're all different. We all have different situations in life, sets of circumstances. And so what's right for one person at a given moment won't be what's right for another person. And one way to think about it is that the way we earn money or acquire it is very personal and idiosyncratic. Then the way that we use it and obtain our goals in life will inevitably be very different. And so what I wanted to do is give some examples about this. And it involves my own personal finances. So on podcast 382, which was way back in, I think, the end of August, beginning of September last year, I talked about planning for your mortgage going up. So we're in a cost of living crisis. We all are. I'm in it. Andy's in it. We all are. And that was before we had the mini budget and the craziness that went on around mortgage rates then, and they started to rocket. I talked about living like it was the winter of 2023 or beyond. So planning for the fact that your mortgage rate would be going up if you had to remortgage in the next year or so. And I talked about setting money aside to build a buffer so you could cope with that. And similarly, we've talked on the podcast about doing the same thing with energy bills. And we've talked about where energy bills might be in the winter of 2023 versus where they were in 2022 and 2021 to give people an idea that they still need to be putting money aside. And that's being prepared. Now, there is famous British Army adage, which I'm not going to say the full 7 Ps because one of them's a swear word and we'd have an explicit rating on this podcast, which would be unfortunate. But the 6P version is proper planning and preparation prevents poor performance. Now, you can kind of apply that to your finances. So going back to that episode, I've been living the last year or so as if it's been the winter of 2023. So I've been putting money aside because I knew my long-term fix on my mortgage was coming up. That is just the situation. It's bad luck in terms of what's going on in the market, but I don't regret any of the decisions I've made financially because they were made for at the time in terms of the products I took out based on my circumstances, the flexibility I needed. So the reality is you can only play what's in front of you. So I've been putting money aside and living like it's the winter of 2023. So I'm going to have to be remortgaging. And the reality is my mortgage is going up significantly. So just to give people some idea, like many of you, my mortgage is probably going to go up about 30%. Now that is a huge amount and it would normally be keeping me awake at night. But what happened is when I started talking on the podcast about preparing, I was doing the same. So I've been putting money aside. Go back and listen to that episode and I talked about it. But essentially I was looking at where my mortgage could be if things were pretty bad, trying to pull money aside, build a buffer that I could potentially draw upon to offset some of that increase if need be. And it has meant that my wife's had to be on board with all of this, and it does mean that we've had to scale back more than lots of other people. It does baffle me how I just seem to hear everybody's going on holiday this year and doing all these wonderful things. And I'm conscious that obviously my family aren't doing those things, but I was preparing. And of course, our energy bills have gone up, and I'd been preparing for that as well. Now, it is difficult. Not everybody can prepare. Some people have not been able to set money aside, but I've been trying to put aside as much as I can. And what's happened is my mortgage is going to go up significantly, but I've got this buffer, this breather, so that I'm not now staying awake at night. If you'd gone back, say, 3 years ago and told me where I would be in terms of mortgages and energy bills, like most people, you would have been having sleepless nights about these things. But because I'd planned and done exactly what we talked about on the podcast, I've now got this breathing space. And we don't know where mortgage rates are going to go. They could fall in the next couple of years. I mean, that's what the market's predicting. And so then we may have this period where they're higher, but because I'm prepared for that and I'm drawing down on that money that I'd put aside, it means that I can navigate the situation. And in fact, I will be marginally better off than I was last year because I've been saving like crazy. So I don't have to be quite as conscious about that now, because now when I get my mortgage, I know what I'll be paying. So the message is, it's the plan that's important. I can't control what the government does. I can't control what the central banks do. And so by planning, I've managed to build that buffer. Now, there are going to be lots of people who are going to remortgage this year and next year. If you're not already doing that, planning on where your energy bill will be. When we last looked at it, and these may have changed now, it'd probably only be about 10% lower than what it was in the winter of 2022. Mortgage rates, use the repayment calculator that Money to the Masses has online. We'll put a link to it to see what your mortgage rate could be if you are on a fixed and you're about to come off it in the next year or so. And we'll link to our articles that predict where rates are. You can look at the best buy tables that we have to show you what rates are at the moment. And I have to say, in the last week or so, mortgage rates have been creeping back up again on the best buy tables by about sort of 0.3 to 0.5% as the market is readjusting its prediction of where the base rate is going to be in the future. It's actually gone up a bit because of how sticky inflation has been. So the message is plan. And I feel like Hannibal from the A-Team when I say I love it when a plan comes together. So what my plan does is doesn't control the future, but it's given me a buffer because I planned ahead, a contingency. So please, if you listen to this podcast and you haven't been thinking about that, then do so, because like me, you'll get to the point where I'm not going to be happy about how much I'm paying for my bills like everybody else, but I'm able to sleep at night with it. And then hopefully things will start to come down in the future, but I don't have control of that, but I have a contingency, a plan in place. So it's a bit like having an insurance for the future. And again, insurances are one of those things we talked about on the podcast, about that fallback, that plan. One of the things also I want to talk about is that it came to light at the podcast event I did yesterday, and people were talking about not having a pension, or how old they were when they started having a pension. Now, throughout my working life, I've been employed by large companies, smaller companies, and companies that don't give benefits, and obviously I was pre-auto enrollment. I then became self-employed, become a business owner with Money to the Masses. So my journey has been quite convoluted. And so pensions as a priority has changed. Now, auto-enrollment has been fantastic, making people save into pensions. Yes, they can opt out, but realistically, the free money on the table from employers means that I think it's 10 million people are now saving into pensions via auto-enrollment. But any point that I wasn't able to pay into a pension, I might not have had a pension, but I had a plan. And that was a line that I said yesterday at the podcast event. I talked about how at that point in my life that I was saving heavily into ISAs, for example, and they were being earmarked for me, for the very long term, but I needed the access potentially to that money just in case, because of my life at that moment. And my money was still in a tax wrapper. It was still being protected from HMRC. So I was still optimizing returns on my money. But in the future, if I had sufficient earnings and I felt comfortable, I could take the money out of that wrapper, put it into a pension, and assuming I had sufficient earnings, I could get tax relief on that and put it into a pension. So I had a plan. There was a plan, even if somebody looked at what I was doing at that time, because I wasn't employed and because I wasn't benefiting from auto-enrollment, and be thinking, you're not paying into a pension at that moment. And they might think that that was something that was a problem or negative. I had a plan. So please, if you listen to this podcast, think about your own finances and what you're doing. Have a plan what you're going to be doing. Don't leave things to chance. And I do personally worry that a lot of people out there, only because I've heard people say this, is that, oh no, the government will do something, won't they? Because I think people have got used to this notion that the government will bail people out. So we've had the financial crisis and we've had bailouts of banks. I mean, we're still seeing an element of that in America at the moment with the banking crisis. But of course, when the pandemic came, we had furlough. And I've heard somebody actually say to me, yeah, but if we all can't afford our mortgages, then the government will do something. I think that thought process we have to move away from. Do you really want to be relying on a government that's going to come and bail you out? You need to take responsibility for yourself. So do plan your finances. The other thing that I've been very conscious of is paying down debt. So clearing debt in an environment like this is key. So it means that I'm at a place that can cope if interest rates rise even further, because I'm not paying any more money than I need to on things like debt. And also, if you are thinking about pensions, there are people who maybe put money into investments or pensions, and they always think about, what should I do in a crisis like we are now, cost of living crisis? And I use the analogy of a dimmer switch. You don't have to turn things on and off like a light switch. You can use a dimmer light switch, i.e. turn them down. So yes, auto enrollment at work, you want to be getting your match contributions, so contribute to your workplace pension if you can afford to, so you get those match contributions. But if you are maybe investing in the stocks and shares ISA as well, and you have to turn down your contributions for a while, then that is fine. Try not to turn them off if you can afford it, because turning them back on is always a hurdle. Turning something down and turning it back up again is far easier psychologically than turning something back on once you've turned it off. But then set yourself a plan of when you will increase them again. What triggers will cause you to be able to feel comfortable to pay more into, say, your investments. And go and listen to podcast 281 where I talked about accessing emergency funds. And I think that is important. I did that episode just after the pandemic. It was July 2020, because I think we have to realise if we are in the place where we've built emergency funds, they are there for a reason, and there are times where we need to access them. And I know that can make people feel uncomfortable, but we have to realise that's what they're there for, to give us that flex. And just like other people in this world, I will be accessing money I've put aside. I would love to be sitting there just to ride out this very difficult period that everybody finds themselves in.
I really like that, Damien. A timely reminder that it's good to have a plan, and if nothing else, it helps people to sleep better at night.
And one final point on the plan is don't obsess about it. I think of this like trying to drive from, London to Edinburgh. And I have a plan of how I'm going to get there, that I might use my sat nav or what time I'm going to leave. But traffic and all sorts of things happen along the way. And I always build in enough time, that flexibility. But the planning part will hopefully get me there. But I fully expect it won't quite be executed or go as smoothly as I would hope. That is part of the flexibility element. And the reason I quickly point that out is that the FIRE movement is an extreme version of plans. And while I applaud people who want to do that, I do think that life doesn't quite fit into the neat box that people want it to and follow set rules. And flexibility is always key, but it's better to have a contingency plan that adapts over time.
So that is it. We are done for this week's podcast. If you want to get in touch with Damien, you can do so in the usual way. It's damien@moneytothemasses.com. You can contact me if you've got ideas about the show, feedback. It's andy@moneytothemasses.com. Don't forget, we've got the Facebook group as well. Go to facebook.com/groups/money to the masses. And so that's it. We're done. Until next time.
Until next time.
Whoa.